Okay, thanks so much, guys, for joining today. This is our third monthly webinar of our CPG Unpacked series, and we're super excited. This is looks to be the most popular one yet, in which we're basically talking about investment, board members, advising, consulting, all of the things around raising funds and scaling at retail. So let me introduce you to Chris Robb. He is, as many of you probably know, but he is the managing partner at the Angel Group, but is a longtime brand strategist and entrepreneur, advising and investing in early stage brands since 2014. Since recently launching the Angel Group, which is a community of investors and thought leaders looking to strategically invest and advise the most promising emerging brands. So hi, Chris. Thank you for joining us.
Thanks, Ashley.
And then also here is Jamie Borteck. Jamie has spent over 25 years in the CPG biz, holding executive roles in both sales and marketing, spanning from conglomerates like Kraft to Justin's, but now is focused more on the emerging fighter brands, which I love that term. And we've actually worked together on brands like Ithaca Hummus and Dewey's in helping them succeed in their retail growth goals. So thanks, Jamie. And then my name is Ashley. I'm head of business development here at Social Nature. In case you don't know who Social Nature is, we are a digital rebate platform that help brands get new customers at retail, insights to help defend your position on shelf, and reviews for syndication to retailer sites. For all registrants who attend today, we're offering 500 free activations if you want to try us out. Just let us know at marketing@socialnature.com. That is all of my planned speaking notes. And now I just want to have a roundtable discussion. So like I said, there was a ton of interest, and there are some specific interesting questions that folks have inbounded with. So why don't we start with overall fundraising climate for CPG? I'm curious from your perspectives, is it as bad as everyone makes it sound to be?
My perspective is it's definitely been a tough time. There's no way around it. I think venture capital is down. I don't have the exact percentages today, but it's significantly down in the last 3 years. So, it puts a lot of pressure on different types of, funding opportunities that exist that are still coming into the space. I think you've got external pressures, around economy. You're still kind of feeling the effects of the pandemic. You're still, you're feeling effects of things like election, right? There's just a lot that's happening right now. And for whatever reason, venture dollars in particular the last 3 years are just not coming into CPG the way that they, historically have kind of last 15, 20 years, right? So, definitely a difficult time. What I will say is that it's still possible, it's still happening. People are still raising money. I think that people still like this asset class. People still understand the value of investing in CPG. It's a nice place to diversify your funds outside of the variability that you have in something like early stage tech, for example. So it's a place where you can still generate outsized returns if you especially if you're an angel investor and things like that. So there's lots of opportunity to get capital into your business. But I think you have to understand, just how to communicate the right story. And it's just about, a methodical approach to getting it done. It's a little bit harder than it used to be, right? And so I think it's possible, but you got to put the work in. That's my viewpoint on it right now.
Yeah, I mean, I'd say it's pretty accurate. And just
Yeah,
to echo that,
mm-hmm.
no, it's just generally in the industry, it's been a tougher time. So brands are really learning to like survive on their own and figure out their unit, economics and get by and finance in different ways, different forms of debt, you name it. But at the same time, I'm still optimistic. Like in the end, like good brands persevere. You have really great velocity and margins. Like there will be attraction for it. Um, and I think the interesting play will be to watch interest rates, like, those at a very super high, let's say over the last year, I think also made investors retrench because they could earn a great return just in the market itself. As those go down, maybe certain entrepreneurs and investors um, feel like they could earn more by investing into these startups. So I'm hoping that would pick up for a lot of brands. Also optimistic, you see in the last couple of weeks, industry wise, like you've had these great huge plays like Siete or Ghost that, make it realize like there is a return for these brands. It excites investors. Um, and maybe there'll be, times that we'll see more normalcy, but to Chris's point, it's definitely has not been easy for brands, and it's not like there's an easy solution right away here.
Yeah, and Siete, I'm glad you brought it up because that was a big moment for the industry to kind of get things back on track, I think, and uh I anticipate more, by the way. So every time you have an acquisition, it kind of sparks activity and interest in the space saying, okay, this is alive and well. um I also think you've got a lot of portfolio refinement with various strategics, so offloading legacy brands or SKU rationalization, things like that. So those are opportunities. The other optimistic angle that I have is you've got, with less venture dollars coming into the space, you've got less trade spend, right?
Mm.
So that your dollar that you do have goes a little bit further. That said, there's corporate retailers that are obviously putting pressure on things like cost plus programs, and there's different things that are happening that are putting pressure on brands at the same time. There's inflation, right? There's a lot of different moving parts, but just purely from an investment perspective, when less dollar, it's kind of forcing this era, it's forcing capital efficiency. And I think that's a good thing for the industry. I think we were way out of whack, right? I was just having this conversation with another brand that's profitable this morning, and he was telling me, he's like, yeah, we built our business for 5 years on a $3,000 investment, and 5 years in, we raised our first round, and that was the first time we really made some mistakes, because we spent money that in ways that we wouldn't have otherwise, right? And so I think that when you don't have cash, you're forced to kind of develop this ingenuity that makes you more efficient and sometimes more effective. And so I think there's good learnings that entrepreneurs are going through right now that will help them set them up. And I would encourage people to just consider the fact that when you do have cash, you should try to maintain that mentality and just be super smart with your spend and selective with your distribution and so forth. But these types of acquisitions, it's going to fuel more dollars coming into the space, in my opinion, and that's something that everybody's going to be able to kind of feel the effects of the tailwinds.
Okay, two things. Chris, can you turn up your volume? A couple people say they can't hear you, so
Yeah.
I think everyone's like getting closer to the computer to
Sorry.
So speak louder, turn your volume up. And then a question popped in, and I love this. Just like keep peppering us with questions because there's I think this conversation is going to get pretty chewy. So please do. So a question came from one of the attendees is, what are our thoughts on whether VCs appreciate bootstrapped approaches?
That's a good question. So go ahead, Jamie.
Yeah, no, I think in general, more or less is yes. They appreciate it. I think they see that you know how to manage money, you're careful of it. At the same time, based on the goals of that investment and the type of offense you want to play, they want to make sure you're on board to driving sales and not being too rigorous in your spend. But more than not, they want people who can get to positive EBITDA, and that is based on a really good financial construct and mindset. And now their money can go to just driving incremental and not be basically going against mitigating loss. Chris, anything you'd want to say?
Uh, yeah, I can speak for myself, which is something I really appreciate. I think venture historically looks at top line revenue in this industry as an indicator of adoption, but in my opinion, that's a mistake. And I'm probably a little bit more unique in that sense. I do think that people still look at revenue as as a driver. And what I always say is like, I really care about how you get to 1 million or 2 million more so than getting there. And I don't know that everybody shares that sentiment, but I think we're moving into a time frame where you have there's an awareness now about capital efficiency as a concept. And I don't think that existed pre-pandemic, right? So from that perspective, I do think there's a new appreciation for it. I still think strategically, you need to make sure there's alignment with your investors on how you want to grow. And I cannot overemphasize that enough. You're not going to be the right, like too many people come to investors and say, I just need cash, just give me some cash, right? You may not be aligned, and it's as important for you to make sure there's alignment as it is for them. And so I would treat every investor conversation that way and make sure that you guys have the same goals and the same plan. And part of that conversation is understanding, how scrappy do my investors want me to be? It's not for everybody, right? And so just work out those differences as part of your initial conversations, and you save a lot of time for you and them.
Yeah, there's about 3 or 4 questions around this particular topic, which is basically like, how do you recommend brands evaluate potential investors to ensure you are in alignment? Is there like kind of like buckets? I mean, I understand that you kind of spoke to scrappiness, but is there kind of like quadrants that you think alignment is necessary? And I'm assuming, different questions that you might ask to ensure that there is that alignment.
Well, growth plan is one, right? How do you plan to grow? That's a big place. The most important place to start, because it's going to dictate, how many resources that you need on the timeline that you need them. So I think that's a good place to start. And then I think looking ahead, something that people don't talk enough about is, what's your plan? I think too often it's assumed that, an exit is your plan, is profitability your plan, optionality is your plan, right? So I think understanding a bit about where you're going and why you think that you'll have success if you do what you say you're going to do. I think that's something that oftentimes gets overlooked in these conversations around alignment. But Jamie, feel free to hop in on that one.
Yeah, I think those are good ones. I would just thinking out loud, I'd add like time horizon, depending on the size of this, and certain investors are at a certain time that they want to get to an exit. That may be, and some people are way more patient with it. So I think that's a key thing to understand the time. I think they're just basics of maybe the style and personality. You're going to be working with these people hand in hand, and so sometimes there's founders that are, you're very used to running a business a certain way, and you want to make sure you're at a very even understanding of like what that life is going to be like for you, uh, moving forward and working with them, and just be on the same kind of like understanding of reporting. So, more often than not, it's like the people that are really good for you to be around, who are going to encourage you to be at your best to help your business. Um, are going to be great long-term partners for you to enjoy the ride as well.
Yeah, one of the things that I've observed in the last couple of years here at Social Nature was, I want to say pre-pandemic, the average brand that we were working with would probably be, I would describe as high growth, so in over 2,000 stores. And they would be launching, a handful of new products a year. And one of the things that I really noticed in the last few years is that's not happening. Brands are way more defensive. They've, cut their product launches in half, if not more so. They're really just focused on defending their position on shelf, maybe a product line extension. And I'm curious to know from your guys' perspective, and again, even with brands that are getting acquired, the first thing the acquirer often does is slash product lines and just really looking for those like capital efficiencies. Is that something that you both have noticed as well? And is like any comments around kind of how brands can get a little bit more efficient in their go-to-market?
Sure. I mean, I could start here. I think maybe what I'm sensing, Ashley, one of the underlying factors might be just a focus on velocity on a per item basis. That might be one of the things that you're seeing. So whether that's just long-term trying to stay alive in certain accounts or be at the top tier, you know, or strategically down the road feeling like they have these top winner SKUs that are amazing. So that creates the focus on those core SKUs winning, doing really well versus blanketed, say TDPs or blanketed innovation and items. So I think that's the underlying factor if I understand what you're seeing. Um, and I will say, I think that is pretty valid when I was at Fucha Tastes Good and we were acquired by General Mills, it was good learning for me because they really dug deep into the top items and the velocity of those top items. So as a large company, they had to bring Fucha Tastes Good into like the big portfolio with their big sales force. And down the line, it was unfortunate to watch, but down the line, they were scaling back to like a top three item mix. And so I think underneath it, they look at it like that to say, what are those top winners that are going to make it so big? They're going to fall into my big system, and the smaller ones don't survive. So
Mhm.
there could be some portion of that. I don't know, Chris, if you'd add anything there.
Yeah, I always like to say there's everybody has a biggest winner and a biggest loser, and I think it's really important to be objective and look in the mirror at your product matrix and say, okay, is everything working here? And it's if you've got some dogs, sometimes you just gotta, accept it. And the other thing too is I think people feel like they've got to create more SKUs or they got to get into more categories, for various reasons. And I think it's just important to be very intentional, and if you launch, 4 SKUs into the category because you think that you need to, or you think that this is going to create a billboard, I think the other thing that it's obviously category dependent, but when you create an additional SKU, you can also be impacting your velocity potential for any one SKU. And so it's, you can look at it and say, well, it's this incremental sales, but you also have to look at it and say, am I taking away a core customer from a core product? I would always rather have less SKUs and more places in the store, or less SKUs and more facings than more SKUs and less velocity.
Mhm.
So just as a rule of thumb, you should, and not enough people understand their numbers. If you don't understand, this is one of the, Emily, who came to work for us full time, who's, just right out of U of M business school, Jamie. The first thing that I could teach her when she was started to do these calls with us is if you don't know your numbers on the first call, you can't look at paper. Like if you don't know them off the top of your head, that shows me that you don't understand your business. And you need to understand your unit velocity really in any account, on a per SKU per store basis, on a weekly level. And that's just something that you need to know in order to operate your business effectively in CPG, and to stay on top of those partnerships and the sales conversations and your innovation pipeline and why I would do this versus do that, right? So um, I'm always more impressed when you can build a revenue story that is bigger, with less SKUs, than a revenue story that's bigger with more SKUs.
That makes sense. And just to give more context to what you are talking about, maybe you can give us a little background into your new venture, the Angel Group, just so I think many people tuning in might be wondering
Yeah.
kind of, who's getting in touch with you these days and why, because I know it's quite different than from Dirty Hands days.
Yeah. Well, Angel Group is, I mean, angel groups exist in different sectors, right? There's a lot of angel groups in tech, for example. And essentially, it makes sense for companies and it makes sense for angels, right? There's power in investing together. And it's also makes it a lot more efficient, for companies to be able to reach kind of a group of people versus having to have individual conversations. And so there's just a lot of efficiency that's created with the core function of any angel group. Our angel group is focused solely on CPG, primarily food and bev, but really anything that's, could be sold in the grocery store is kind of our core function. And we curate a group of accredited members, based on 3 criteria. One is you need to be an accredited investor, basically in a position to invest legally. You need to be passionate about early stage CPG. That's the core function of what we do. And you just need to be good people, good people like Jamie, you've got to have like, for me, the way I describe that is just, empathy for founders. It's helpful. A lot of people that are in our group have worked in this industry, and so they have context for how hard it is, in particular. But it just, for us, we're building and formalizing an intentional community, that has a very clear focus. And so that's how we kind of refine it. We have over 200 members now. And we're still growing at the moment. We probably will cap that here at some point soon. But really, our goal is to diversify risk, or mitigate risk, by bringing in value add investors, right? So people that are, yes, writing checks and putting in cash, but also, bringing their value and their perspective, which is, successful people in this industry that have experience. So we mitigate risk by helping founders avoid pitfalls, and also by contributing and adding value. And whether that's, opening up a retail door, or, connecting them to a distributor partner, or helping them think through strategy, things like that. That's what we do. We typically invest into companies that are in the pre-seed, area, kind of earlier than venture, but past friends and family round typically. And then it's an opt-in group, right? So we host virtual calls with our membership, and people pitch their products. We're religious about product, by the way, and trying product and making sure that we're seeing, if it's not revenue, making sure that we're seeing traction, with customers. And then people make their decisions, and we kind of organize it. So it's called a syndicate. And we do the work to pull people together and make bets on about 8 to 10 brands per year. So hopefully that's a good context.
That's great context. And I saw that there's an open application process. So what are some of the common mistakes that you see in those pitches? Because I'm so curious, if you're investing in 8 brands a year, how many applicants are you getting these days?
Thousands,
Yeah.
well over 1,000. Especially in a time where it's tougher to find cash. I think if you're a place that does invest, there's a lot of inbound, and then we have a lot of tentacles. Every single member sees deals, and we have a Slack channel, and we're constantly looking at things. And it's more than a full-time job. There's 3 of us doing this all the time, looking at things and trying products. My wife jokes, because our house is like a distribution center with all the boxes and the products that we're trying. But it's also it's a lot of fun. But like I said, I mean, we're looking at the products ourselves. We're trying everything. We're trying it with our families. We're really, really looking at things that way, from a product perspective and experience and brand. And then we, from there, if we really like the product, that's usually the first step. Then we'll spend, we'll set up a first call, and, people is the next most important thing. Those are the 2 hardest things to change. And from there, if we feel like those 2 boxes are checked, then we'll get into the financials and the diligence, and we'll confirm data and do the different things that we do to really kind of vet an opportunity. But for us, it really starts with product and people first.
That makes a lot of sense. And I already have questions coming in. So product and people first, and then how much does brand storytelling, community building, those kind of pieces come into play?
I mean, I think it all matters, right? And that might be the special sauce of a particular company, that there's this incredible story, authenticity, and cult following that just blows up. And so I think it does matter. Yeah, you have to have all the other, I don't know if there were other components in that question beyond the
Yeah,
storytelling.
qualitative factors such as team dynamics, brand storytelling, potential for community building. So that makes sense. Just like kind of overarching, like what's the brand's position within the market?
Yeah, and I would say team dynamics is almost like a totally separate idea, which is how strong is that team as hustlers to really get results and understand it and um, persevere through whatever challenges the brand is going to need to go through. So that plus authenticity, story, and cult following, I would say, are very big. But on top of that, probably there are plenty of other things that, say, Chris and the Angel Group would look at um, in business dynamics. What category does it play in? Uh, how are its margins? What's its capacity? All these other things. So it's a huge list that people look at, but the ones referenced there, I'd say, are paramount.
Mm-hmm.
Yeah, and I think differentiation and how big is the category, what's the potential of this, those are important things. But looking at it, does the differentiation line up with where the world shift is going, and then are the products exceptional within that differentiation, right? So you can't just have something that's differentiated that doesn't perform. You need to really check both of those boxes. And I think I see a lot of stuff that checks maybe one of those boxes, but doesn't do both from a product perspective. And that's why we always start with product, right? I think we, as seasoned investors who exist in this category for over 20 years a piece, we have a lot of context for how this industry has emerged and developed, what trends look like, how they come and go, where we feel like the consumer's moving towards imminently. And so I think it's really, really critical. And this is another mistake I see people make is launching products too quickly, just getting something to market for the sake of, like, really, really be intentional and make sure that if you're going to go through all of the effort to put this into a box and put it into the warehouse and get it into the stores and sell the buyers, and get everybody on board, like, the thing's got to work, and so there's, so much work that goes into having something that really can create resonance. And I have a lot of value and respect for people that are willing to do that work, because it's a lot of hard work. And sometimes we're willing to come along for that risk. But most of the time, even angel investors are gonna wait for people to prove that they can accomplish at least that first run. But to Jamie's point, the resonance thereafter with the customer, it really matters to the investor psyche, and how customers respond. Again, I would argue that revenue is less important these days than proving that what you have is really striking a chord with the customer that you say is going to, be a huge part of your trajectory and category.
Yeah, one of the interesting things that I have found, as you guys both know, through Social Nature, we have the ability to ask custom questions pre and post trial. And one of the biggest surprises for founders are questions that relate to target market, product positioning, product attributes, category insights. And my point to say is almost everyone that comes to the table thinks they know. And I want to say 90% of the time, what they think they know is right, but it's not the most right. It's not the most correct. And when we're talking about your positioning in the market, so many surprises have come out. What actually resonates with the top consumers that love your product. And they thought it was a millennial mom product. Well, actually, it turns out that people in urban cities without kids love your product more. And that has just changed the total trajectory of where they go next. So it's just really interesting to both of your points, that taking the time to slow down and really just understand what those insights should look like for you as you kind of expand out, because it really can change the trajectory of where you go next. Switching gears for a moment, Jamie, because I know one of the things that folks want to know more about is kind of your role as a board member. And I know, Chris, you're also a board member, so these questions play out well for both of you. But I think there's kind of some misgivings about when to set up a board, what kind of problems to go to your board with. Can you comment on some of those kind of approaches? Because I think that would be really helpful for the audience.
Absolutely. I mean, I don't think there's really a rule for it, but traditionally, as an independent board member, which I think is, Chris and I sort of very often, and those that, let's say, understand what the founders are going through, I like to be helpful, right? You want to be there to kind of like help whatever problems are happening, and be there as a soundboard, but you also aren't in the weeds of it so specific that you're seeing like what might be coming next. You might have seen that in another business. And so you're always kind of, well, think about this. And so you're helping them see ahead and be successful, avoid pitfalls, all that kind of stuff. Additionally, as you, in many cases, like maybe to your question of like when a board is more traditionally, it feels like it becomes uh, set up through, let's call it a Series A or some form of investment that forces that hand to set up a board where an investor wants a board seat. And so I think it's definitely very important as you think about that full board, you've got some diversity of background, thought, experiences to kind of pitch in and help across the full gamut of the business. As an independent, I try to do the best job, for what's right for the business, really with an empathy for those founders and what they're going for, but also understanding how the investor might think and other board members may think to try to help be someone who kind of makes it work and makes the founders understand that and the why and get us all gearing in the right spirit as one board and one team to be successful. So sometimes I think, you'd have to ask founders themselves, what's been helpful or not, whether also, Chris and I be like a mentor or advisor into a business that's just pre-series A, and you're like that role, but there's no official board. You get to know each other, then all of a sudden you do form a board and you're like, okay, I know this person, I trust. The chemistry is so great, they're the perfect shoe-in to be that board member. That can happen too. But I think that inevitably, the role of that board and that kind of group placement, I think is really a good. I enjoy it, and I appreciate it as an operator myself, reporting into boards, and I appreciate it as a board member getting together more typical on that quarterly basis together and taking a step back because so many times businesses are so in the weeds, getting this done this day, this week, moving this, moving that. And then you come back and you say, well, great, but like 2025 is coming up pretty soon. What's the plan for that? And it helps really like get you all geared up for the big things that matter most. And you have some really rich conversations to create a sustainable, healthy brand and business. So hopefully that answers your question, Ashley.
Yeah, and
Yeah, that's
I'd add that I think it's accountability, for everyone as well. I mean, and those touch points are really meaningful when you can come in at that high level and check in on, okay, what did we say we wanted to accomplish this year? And look at, 8 different zones of the business and say, well, this is what we talked about. We kind of aligned on this vision here. How are we measuring up against those goals that we set? Maybe where are we falling a little bit short? Where could we put a little more emphasis? So, I mean, it's really an opportunity to kind of come together with a diverse skill set and perspective and at a high level with your key stakeholders to really guide the business at that higher view. I think that it's also it's more work, more legal cost. There's practical considerations of when to create a board. I think it probably makes more sense, when you go through more of a priced round versus if you're still operating on convertible notes or safes or things like that. In my opinion, you can still have the function of a board with great advisors, and I'm a big believer in surrounding yourself with great advisors. It's something that we believe is a core function of why we were motivated to create the Angel Group with all of these great, people that we can surround different entrepreneurs with, particular domain expertise, particular perspectives where you may be short on as a founder in the early stage, where you don't necessarily need to hire somebody internally who has that skill set, but you can kind of bring in somebody that can be a trusted, experienced, guide for you and your business that you can build a relationship with. So you don't have to have a formal board of directors in order to have a board function in your company. And you can definitely do that through, onboarding great advisors and make them stakeholders in your business.
Yeah, for sure. And I think one of the things that Social Nature did early on was set up an advisory board to ensure that we were not just working in the business, but on the business and from year one, just to make sure that it kind of forced you to kind of level up and take that bird's eye view. Otherwise, mistakes are made. So it makes sense. And I'm sure we've all made lots of them.
One thing I'd say, you can have informal advisors as well. People that just want to be sounding boards, people that believe in you just because, and I've got a few of those that just people I like, I believe in, I want to be there for. They're very early, in most instances, but just a sounding board, call me up, text me, let's hop on when you need to, when you got something going on. But I think that the best advisors are the ones like Jamie, frankly, I've seen it firsthand, who are in the weeds, nitty gritty, adding a ton of value to your business, as somebody who's in that position to do so. And, if you take that opportunity to build great advisors into your business, it is a tremendous opportunity for you.
Yeah, I couldn't agree more. Okay, there is another juicy topic that I want to unpack, and we are running out of time. So let's talk about growth at retail, because it is a big, juicy topic that lots of people had a lot of questions around. Let's talk about just maybe some advice you have for brands, and when is a good time to really go for, like, for instance, national growth or growth from specialty natural like Whole Foods and Sprouts to like a Target and Walmart. Like some of those signals, this happens every webinar, but there's a lot of questions for both of you around this. So any advice there?
There's a lot to unpack. There's a lot to unpack in that. And I think it's very different for every category is the first thing I'm going to say. Depending on what your unit velocity potential is for, your particular category has a lot to do with how I would set up a strategy. So there's not a straight line answer. But there's a lot of, folks who will talk about kind of regional density, and I believe in that completely in terms of, owning your own backyard and all that kind of thing. But sometimes your MOQs are high enough to where, you need to maybe generate some volume that's outside of just the regional independent, markets that you can go into. So there's, again, not a straight line answer, but one thing I am clear on at a high level answer is that especially when you're young or starting or emerging and you're a young business, you are going to be at your most inefficient period of time, right? And so it's important for you to go to where your core customer is, and sometimes that takes you outside of just a region and it takes you into some other places. But as long as your core customer is there, in this market that you're going into, I think there's a good argument to make that's part of a good strategy, especially in the early goings. And part of what a core customer means is somebody who's willing to pay the price that you would like them to pay at a sustainable margin. And there's enough people there to kind of, maintain your unit velocity expectations with those retailer merchants. It's really important to understand what the retailer's expectation is for you on any one given SKU. And then it's important to understand that your dollar contribution is enough for them and for you. So I would really think about your retail strategy as it relates to those key points and think about, are there enough customers in this store to make it worth for me going into right now? And as you create efficiencies, that starts to open up your opportunities to go into retailers that maybe have more price sensitivity with their customers. So that's the highest level answer I can get, but there's just a lot of dynamics, within your categories.
For sure.
I would just add, yeah, I think you want to get some proof of performance, let's say in your core accounts in velocity that make you feel that much more confident, we can step up and perform in this, let's say, larger conventional account. I think you mentioned like Target. Um, so I think there should be we have enough like proof in our initial concept, and we've optimized it well enough. Maybe we've been in market enough time. We feel like we could be at an acceptable price to feel good that we can perform there. And when you have some of those proof points, and let's say you have the financial backing to know, okay, to go there, it's going to be lots of stores that might need to build inventory and use of cash, or we're going to need to pay slotting, or we're going to need to invest in trade or whatever it may be to be at a top tier and stay alive in that account. Once you feel like you have all that, then you know it's you're ready. But if
Yep,
you're
that's
not
fair.
there and you don't have that proof point, you can certainly make the move. And we see it all the time. It's very hard for founders to say no.
Mm-hmm.
But um, that type of like self-reflection and rigor to be thoughtful about it and be successful wherever you go so that it's a sustainable growth versus large ramps of TDPs to then go back down because you didn't perform. That's where, Chris and I probably like try to help people say, like, rethink that. You're not ready.
Yeah, that's fair. It's interesting because I also talk to a lot of brands, and always think of it as like a retail growth consult where, tell me all the retailers that you're in, and then which retailers do you want to zero in on and why. And sometimes I feel like brands have retail buyers that they're so used to supporting year after year that that's their go-to. But since then, they've won new retail accounts. And they're like, yeah, but I don't know how it's going to go. So I'm just going to see how that goes first before I invest there. Maybe a region of Walmart or Target, but the return on that investment could just be so much bigger. So it's just kind of interesting to help, and this is also often a founder who is very emotionally heightened about these decisions. So like just kind of deconstructing that a bit too. Last question for you both is, so when do you advise brands to use a retail platform like Social Nature or what other levers do your brands use to help support that velocity goal, seeing as though it is so important in this climate?
I think it's really critical to understand your customer. And so I think it's really powerful when you combine a shopper marketing strategy also with a consumer insight panel, right? And so it's the combination of, that is so critical. And I think there's key moments that I think are more important, right? So a new product launch, right? Or a new retailer launch. Anytime you're launching something, that's a good time to like do some analysis there. Or the other thing would be looking at, okay, these are my core retailers. I know it's working here, to Jamie's point, right? I want to go get some data from these customers. I can use that data now as part of my sales story. I can use that data to understand, who my core customer is and where else they might be, right? So, I mean, there's a lot of different ways to use platforms like that. But I think too often people think about selling into accounts and they definitely don't think enough about how I'm going to be successful, programming this account, right? And there's many layers in how to successfully program an account. And, a platform like this is 100% one of those, things. And I would also argue, and this is to the point around differentiation and category data, but you need to, like, my friend Laura Triano, who runs sales for Mush, said this to me one time, and I thought it was really smart, but you're never too young to start using data. And I think sometimes it's daunting, especially when there's so many things, other things to spend money on. But, even a little bit of a spend on data can be really, really critical for you when you're validating not just your own idea, but when you're validating the category. And I think it's really something that people need to be familiar with out of the gate. And so I think whether that's consumer data, whether that's shopper marketing, whether that's, Nielsen spins, right? Like those are things that I would encourage people to to get a handle on, especially if they're not comfortable, then it's something that you need to educate yourself on.
Mm-hmm.
Really. Just to echo, I do think the most common situation falls into like customer specific. All right, we just got into this big retailer account. We've got to win. We've got to perform. And so it's so what do we do? How do we go about it? So then you assess what tools are really best specific for that. And there are some that like only work with this retailer. There's some that you can kind of tailor it. Uh, so that matters. I would say, a plug for you all at Social Nature. I think it's a great tool because it does so many things. I remember when I first discovered it, it just hit, like you can walk away and say, we're going to do this very specifically for this retail account and package it into a deck that the salesperson can come and say, look what we did and focus just on you, right? That shows you're dedicating and you're forming like the category manager relationship of it. Additionally, you get this like trifold of benefits from it. Not only are you getting specifically to people who live geographically around that retailer that you want to perform, who are very interested in your category to go out and buy it. And so it's almost like a demo, right? Um, which is very hard and unaffordable in most accounts when you're trying to do an in-store demo. So you get that benefit. You're moving units out the door and you're getting trial very quickly that might form into repeat, but you're also getting reviews and you're getting verbatims and you're getting, to your earlier point, Ashley, you have questions, you can ask specifics to learn about it. You might, laddering to the prior question about like, when do you move? When do you jump? You might support all this and want to win, but you also kind of learn some insights from this program that made you want to improve your packaging or feel like, oh, we actually just learned that we're not ready for this other account because we have so many other things to work on. Sometimes you're somewhat blind to that because you launch an account and for 8 weeks, founder may say, we're doing great. We got sales, we got a reorder, and it feels like we're doing really well, but underneath it, there might be some things that you could be doing better, or factors that are why you're doing well or bad, but consumer feedback and insights will give you the full reality check of where you should be going. And so, I'd say props to what you guys have created. That's one of them. Clearly, brands use Instacart and about it and all these different things that all have value in it. But I'd say very customer specific programming is one that these brands typically think about these types of platforms for.
Yeah, and I love the way you guys filter your community members. Like you onboard your members the same way that we think about who we want to be in our community. You guys are building an intentional community and understanding everything about each member that joins. And so I think that's more meaningful than just like simply a trial engine that's just a lever you can pull that's a little bit more artificial, where it's just more meaningful when you can tap into kind of a real consumer psyche that is intentional, and that just the data is a little bit more appealing to trust, in that type of a format. So couldn't agree more.
Amazing. Well, like I always say, you can't fake discovery. It's one of the biggest challenges for CPG brands these days, but shoppers are far too smart. So you have to connect with the ideal shopper. But on that note, this has been so juicy. We are going to ask all folks to opt in to stay in touch with both of you, because I think this is just the tip of the iceberg of what there is to learn from y'all. But I really appreciate the time. Great to reconnect on this particular topic, and looking forward to continuing the conversation offline.
Thanks so much, Ashley.
Thanks,
Appreciate
guys.
it.
Thank you. Good seeing you, Chris.
Enjoy the rest of your day, everyone.
Hey, guys.